Hey everybody, are you paying too much to trade options? Well, if you're not on public.com, the answer is yes. Public is the only platform where you earn a rebate on every option contract traded, and that's in addition to no commissions or per contract fees. There's no one else out there paying trading rebates, so you won't find a better deal. Bottom line is, if you're paying more than $0 to place an options trade, then you're paying too much. Switch to Public and start getting rebates on every single contract traded, only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description.
Hey friends, welcome back to Investing Unscripted, where we ask the hard questions about investing. I am Jason Hall, joined by my good friend, the voice of the people, Jeff Santoro. Hey Jeff,
Hello.
we just saw each other.
We did. Less than 24 hours ago, we were together in person.
We were. It was fun. It was fun, and we talked about the topic for this show, and it's an idea that we've had for a while. And this is definitely going to be one of the kind of more stock-specific oriented shows we do, but also some mindset and thinking about portfolios and allocation, that sort of thing. Jeff, let's talk about dividend stocks.
Let's talk about dividend stocks. But wait, hold on. Before we do, we should give a little more context about where we were. So we got to meet up at Fool Fest, which is an event that the Motley Fool hosts for its members, and we got to go as contractors. And I only mention it because we met a lot of great people, some who are current listeners to the podcast, especially our buddy Eric. So shout out to Eric. But we met some new people who we told about the podcast. So if by some chance you are listening to this because you found out about our podcast this week, welcome. Welcome. Hope you enjoy it. That's all.
If you run a bar in Maryland, we also met you too. And you were pretty wonderful. We're going to drink at your bar one day. That was fun.
One day.
One day.
All right. So dividends. Let's do it. I thought a good way to start, Jason, is to not assume that our audience knows the very basics about dividends. So let's start with the very basics. What are they? And I think more importantly, this is something that took me a little while to wrap my head around when I was new. What's the difference between like the dollar amount that is paid in a dividend and the dividend yield? Because we hear about the yield a lot more than we hear about the dollar amount. So maybe let's just level set some basic understandings here.
Yeah, so we'll start with what a dividend is, and in its purest version form, it's a payment by a customer, by a company, by a business, because they're not all companies. They might be a limited liability company, it might be a master limited partnership, a publicly traded partnership, a REIT, which is a form of trust. It could be a royalty trust. There's lots of these businesses out there. So we'll just say it's a business. It's a payment by that business to an owner or part owner of that business. You may be a shareholder. Coca-Cola, this is like the perfect example. It's a corporation that pays a dividend to its shareholders and it sends cash to them. You might also hear the word distribution. So like limited partnerships and LLCs often pay a distribution is kind of like MLP speak for dividends, but so in the mechanics of it, it's the same thing. You own a part of the company and they send you money. There's tax implications around these different names. So that's why you hear sometimes people will quibble about making sure you use the right name, because there could be implications on how much that particular payment is taxed. Now, here's the other thing. It's not always a cash payment. It's almost always a cash payment. But some companies will pay scrip or dividend in kind, which is shares of the company. Now, that is not the same thing as a DRIP, a dividend reinvestment plan, which is where your dividends are just reinvested in stock. It's because if you have a DRIP or a dividend reinvestment plan, the company pays you cash, and then your broker, or if you own shares directly through the company through their trade agent, whatever it's called, they take that cash and then they buy more stock for you on your behalf with it. So that's important to understand, is that some companies pay dividends and more equity in the company.
Yeah. So, but hold on, let's pause for 1 second. I think for the purposes of this, I think, and you can tell me if you disagree, but I think we're going to be talking mostly about what I would call just like normal dividends, which are just company X well, maybe not company X, that's a real company. Company ABC, ticker symbol ABC, pays 13 cents every quarter to all of its shareholders as a
So broadly, yeah. So
regular
the only
dividend.
time that we won't, the only time that I will kind of get into the minutia or into the weeds, so to speak, is when it's important to differentiate. But for the most part, we're just going to be talking about companies giving you money or businesses giving you money, and then you making the decision after the fact what you want to do with that money. So that's important. Now, I think you might have had another question.
I was just going to say, like, so for people listening who may already own stocks that pay dividends, you may already know this, you may already be doing this, but I wanted to return back to the dividend reinvestment plan, the DRIP.
Mhm.
That's an acronym that you mentioned before, because essentially, yeah, you do have two options. Those dividends will just accumulate as cash in your account, or they will automatically get, that money will automatically be used to repurchase more shares of that company. And
Yeah,
there are a lot.
and your broker gives you the ability. A lot of times, it's defaulted to reinvest. You can go in, and there'll be a setting somewhere you can find under the features of the account where you can change it, like the default for the entire account,
Mhm.
to not or to yes reinvest, whichever you prefer. And then you should be able, with most brokers. I've never seen one that you couldn't. I'm sure some exist that you can change it for individual equities as well.
Yeah.
Maybe some you want to reinvest, and some maybe you just want the cash to accumulate. So that's
Yeah.
important.
And, I'm just thinking through my portfolio of dividend paying stocks. I would say the vast majority of them pay quarterly, but there
Right.
are a handful that I own and a lot more out there that will pay monthly.
Yeah.
Um, I know one that you and I used to and no longer do, but you can still do own, I believe, Realty Income Trust, which is ticker symbol zero. Sorry, not
No.
zero. Oh,
Oh,
um,
right. We think
they,
this is the Japanese stock market or
yeah,
something.
right. It's not the number zero. It is the letter O.
Yeah.
Um, they pay a monthly
EPL
dividend.
EPL Properties pays monthly as
Yeah,
well.
yeah.
In general, so you see a trend immediately right there. The vast majority of companies that are paying monthly dividends usually are REITs, real estate investment trusts. But broadly, most now this is important. It's typically U.S. companies that pay a quarterly dividend. When you see semi-annual dividends, often those are not American companies. So Disney has reinstated their dividend, but it had been paid semi-annually. Honestly, I haven't checked to see if it's going to be semi-annually or annually or quarterly, what their plan is.
Looks like it's
Um,
quarterly now. I mean, just
okay.
I did a quick search on Google Finance and it says quarterly dividend 19 cents. So,
Yeah, but the point is you need to understand the company's their cadence of paying a dividend, especially if you're thinking about investing in it for income. And
so
if you saw their last distribution was $1, you can't just assume you're going to get that the next quarter or the next month, right? You need to confirm what their dividend policy is.
so let's use, just because I have it open now because I looked it up. Let's use Disney as an example to talk about dividend yield. Okay, so
Yep.
If I just Google Disney dividend and the Google Finance page popped up, and at the very top it says that the quarterly dividend amount is 19 cents US dollars, and it says the annual dividend yield is 0.77%.
Yeah.
And I know that typically a lot of companies every quarter or every year will up the dividend amount a little bit. Now, Disney might be an outlier because they just recently brought theirs back. So I don't know how quickly they're going to be raising it. But the dividend yield can change day to day, week to week based on the stock price. So why don't we talk about what the dividend yield is, how it's calculated?
Yeah, it's a real simple calculation. It's just the percentage of the stock price annualized. So if a company pays it monthly or quarterly, if it's a quarterly dividend, the most recent dividend times 4, divided into the stock price, right? So that 19 cents times 4 is
76
76
cents,
76 cents over whatever the stock price is.
right? Which
Um,
is right now around $97 ish.
there you go. And that's where you get that roughly 0.8% yield, right? Is roughly what it is. So
Yep.
here's the thing that is if you're if the dividend is going to remain steady, right? If that fixed rate and you're going to buy the stock right now, right? So that's where yield is useful, is thinking about what portion of your return on investment if you were to buy that stock right now. The two things that have to be true are the dividend is going to continue at the same rate, right? So when we think about things like yield traps, you're buying a stock expecting to get some very high yield, and maybe the market's sent the stock price down because there's a high expectation the dividend's going to get cut. Stock's gone
That'll
down
push the
because
yield up.
it pushes the yield up, right? Because there's
Well,
still,
that's the thing. I think that's the reason I wanted to talk about yield, because I know when
yeah,
I was a newer investor, it was very counterintuitive to my brain that a good thing for an investor, which is a higher yield for the dividend, is a bad thing for the stock. Like, it means
right.
the stock has gone down if it
Yeah,
changes from a lower yield
often.
to a higher yield.
Well, and
Often.
that's one of
Yeah.
the first things you have to look at. Well, if the yield's this high, well, let me just do a little bit of sleuthing and look at the past year. What's happened with the dividend payout, the actual number, the dollars that are paid, the dollars and cents, and what's happened with the stock price.
Mm.
If the dividend hasn't gone up, but the stock price has come down, the market is telegraphing that we don't believe this dividend is sustainable. Right. So that's important. And until the company actually, until the board, now the management doesn't control the dividend, the board of directors controls dividend. Until the board declares what's going to happen next with the dividend, that yield is going to be based on what has already been paid out. Right. So that's where these yield traps can be dangerous. And I just want to say one mindset thing about that I think is really useful is if you have company A that this is their business and this is their yield, and company B is their nearest peer competitor, and there's a massive difference in the yield, that's usually the market telling you that the company with a much higher yield, unless there's some obvious reason why it pays a higher yield. Maybe it's the largest and the oldest and it's well established and it's just returning lots of capital to shareholders. And the other company is an upstart and it's growing and its yield may be lower because of that. Generally, if there's a big divergence, it's because there's trouble with the company that the yield is higher.
Let's continue to use Disney as the example, because I think this is another thing that was slow to kind of internalize when I was newer. The dividend yield that you see, like right now, when you go look up a company you own, may not actually be the yield that you're getting paid on your shares. Am
Can
I?
we use MasterCard?
Sure, we can switch to MasterCard. I
And
just didn't want to
the
Google
reason I
another
wanna do
company
that is I wanna go with a company.
that has had it for longer
Yeah, exactly,
without a
right?
break. Yeah.
That's exactly right.
All right, so let
And
me give the numbers real quick. Currently, MasterCard's dividend yield is 0.59%, and it is 66 cents a quarter.
right, 66 cents a quarter,
So
and
this
the
is my
stock.
question. So if I buy this stock right now, right? If
Yeah.
I stop recording with you, log onto my broker, and I buy MasterCard, those shares that I buy today, if I'm understanding this correctly, are I'm going to get 0.59% yield on those shares forever, because
No,
that's just the yield on my cost basis.
that's the yield on the stock price today, and as soon as you buy the stock, that's the yield on your cost based on the current dividend,
Right.
okay?
Yes. Yes. I should have said that. That's what I meant. But
Right?
that's the piece I'm honing in on, is that I've heard people say often without explaining it. They say something like, "Oh, I'm getting X percent on my cost basis for that, the X percent dividend yield on my cost basis," and I don't think people understand what that means. That's what I was trying to get at.
Yeah, so I wanna explain exactly that, and the reason I wanna use MasterCard is because it started paying a dividend in as old as MasterCard is, it hasn't been public all that long, maybe 20 years at this point, but it started paying its dividend, I believe, in around 2006 or 2007. But really what happened with, MasterCard's dividend that's been the most incredible was 2012, I believe, 2012. They started raising the dividend. MasterCard has increased its dividend 7,230%. Now, I want to give you another little interesting tidbit. You can look at MasterCard since 2006, and its dividend yield has never even touched 1%, one
Mm.
single time. And the reason that's the case is because the stock has consistently gone up because the company has grown its earnings massively. That's how it's been able to afford to pay and raise that dividend 7,000% because it's grown its earnings per share. It's consistently grown its earnings, and the market has continued to be willing to pay a higher and higher stock price because, it's just multiple expansion here, right? The business has improved and become more profitable, so it's become more valuable. The stock price has gone up. The dividend yield really hasn't gone up very much at all.
So in this case, what I'm hearing you say is that the fact that MasterCard's yield has stayed under 1% is actually a good thing because it means that the price has continued to go up.
That's exactly right. But I
Right.
want to
So
get
like
back to the
if we saw all of a sudden MasterCard's dividend yield was 3%, that would be we'd want to go look at why.
yeah, yeah. No, that's exactly right. But
Yeah.
I want to circle back to like the other part of the yield on cost conversation because this
Yeah.
is really important. So on a split adjusted basis, MasterCard stock back in mid 2006, call it $4.50 a share. And again, you bought it back then, you would have gotten a yield of in late 2006. This is when they first implemented their dividend. You would have been getting about a 0.11% yield when you bought it. You would have paid, call it $8 a share
Hmm.
for the stock. So really good year. The stock ran up a lot by the end of 2006. So $8 a share, right? So let's say you were smart enough to have held MasterCard that entire time and you continue to hold it today. They pay a 66 cent a quarter dividend. So 66 cents a quarter, that's what?
264 a year.
So $2.64 a year in dividends on your $8 cost basis stock. So your yield on cost there is what? 28%?
Right.
That's pretty good, right?
Yeah. So, and we'll talk more about this a little bit later, but like that's exactly the point I was trying to get at because I think it's very easy when you're deciding, do I want to buy the dividend stocks or do I not, or should I or shouldn't I? It's very easy to look and go, oh, I'm only going to get 0.11%. Why bother? And then
Right.
fast forward, if you pick a winner, fast forward 20 years, and now you're getting, 20% of your cost basis back to you in cash every year.
Right.
And it can
Exactly.
get to a point where if you hold a winning stock long enough, you hear stories about this where you'll basically make your money back that you paid for that stock every quarter
Yeah.
with
Takes a
just a
long time and
dividend.
you have to be lucky to get that. But
Yeah, I mean that's
um,
not common, but
even like, we've talked about this before and I just think it's such a useful example. Even like Coca-Cola and talked about Coca-Cola and Berkshire
and
Hathaway's
Berkshire,
ownership.
right?
And it hasn't been a great stock. It's underperformed the market, but Coke pays Berkshire its cost basis about once every year and a half.
Right. So
Right.
maybe every quarter was hyperbole, but basically
Yeah.
if you hold a winner
But
long
that's
enough,
still pretty
yeah.
amazing to
Yep.
hold an investment that eventually gets to the point where it gives you your money back every year or two. That's pretty incredible, right? It really is. And when those investments really do well, are the ones that you just set it and forget it and let them reinvest those dividends in that company for you. So you think about, again, I'm going to use MasterCard as the example here, and this is total return. So if you had taken those dividends and just dripped it right back into your portfolio over that period from late 2006 when they initiated the dividend through now, you would have gotten 6,700% in total returns. And yes, I'm cherry picking here. But the takeaway for me is that thinking beyond yield, thinking about stable dividends, companies that are generating enough cash flow to pay a dividend while also reinvesting in their business in ways to generate great returns and grow their business, grow the dividend that they're paying out to their shareholders over time. And you get the benefit of both owning more of the company over time without having to buy more of it. And you end up at a point where maybe 20, 30 years later, where you reach a financial goal where you're no longer looking on employment to be your source of income and you want your portfolio to be that source of income. Even looking at a MasterCard that's yielding 0.5% today, it's done so well for you that yield on your cost and your investments is much, much higher, right? And MasterCard becomes your income stock while everybody else just sees it as a low yield growth stock.
Hey, everybody, we'll be right back, but first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company specific segment and KPI data on around 1,800 stocks. So, for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every week. From hot stocks such as Nvidia and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and level up your investing skills today.
Yeah, exactly. And, this is a little bit more advanced. Maybe we'll get to this near the end, but for people who are looking for dividend stocks to be a source of income in retirement, the other added benefit of being able to, if you're able to do that, is it prevents you from necessarily having to sell your stock to live,
Yeah.
right?
Yeah.
So, if you have been a longtime MasterCard shareholder and you love the company and you love having the stock, it might suck when you're 63 or 68 or 72, whatever it is, that you have to sell 5% of it every year for living expenses.
Well, and then
It, it,
that's, and then
it would
that,
be much better just to live on their dividend.
well, one of the things I've talked about before is when it comes to owning stocks, the worst position to be in is having to sell a stock,
Mm.
right? And because that subjects you to the worst part about investing in stocks, which is the volatility and the market's whims and just a little bit of bad timing. If you were selling stocks to raise income in February 2020, you were fine. If you had to do that same thing again in March of 2020, you had to sell more than twice as much stock
Yeah.
because the market had come down so quickly in basically a month. So that's the other thing that's so powerful about having income stocks and dividend stocks in your portfolio.
So one of the you touched on one of the next questions I wanted to ask you and talk about, which was how investors should think about dividends as it relates to like the total return they can expect.
Yeah.
Now, there's a couple places where this has manifested itself in my portfolio where it's been pretty stark. But if you have either a spreadsheet that calculates this for yourself, or if you're able to, have access to any sort of online website that will show you like the return of a stock over time,
Yeah.
pick like long-term good companies that pay dividends and compare the stock's return, just the
Right.
stock
Stock
price
price versus
appreciation
total return.
versus total return.
Yeah.
And it is incredible in
Mhm.
some instances just how big of a difference it is. And I think maybe while you and I talk to each other, the opposite person can pull up some examples.
I'll use I'll use Mastercard right now. Now, yeah, the stock itself, and again, I'm using that late 2006 period. This isn't even since it went public. The stock itself has done incredibly well. It's done 9,680% in total returns, which is anybody should sign up for that. And twice on Sundays. It is every day of the week and twice on Sundays. It is incredible. The add in the dividend, that low yield dividend, and you're talking 10,600% in returns. And you might say, well, that's not very different. You know what it is? Let me tell you how very different it is. It's almost getting two more S&P 500 total returns over the same period. Over that same period, the S&P total return, 530%. So you're gaining another 900+% in total returns just from that little tiny dividend reinvested in increasing your equity investment in Mastercard. So again, yes, we cherry picked. This is one of the best examples of a dividend growth stock and what it can do. But it's when you walk past the lower yield stocks to chase yield, usually you walk towards risk instead of away from it.
Right. So I'll give an example for my portfolio only because my portfolio is at its oldest point about 4 years old. Right. So it's easy to pull up a stock and say like over the last 20 years, if you, the dividend, the difference between total return and just the stock return is this. So here's just two examples from my portfolio. They're both real estate investment trusts. They're both REITs. So they have decent dividend yields. They have to pay 90% of their taxable income as a dividend. That's why they're in my portfolio. So one is Ryman Hospitality Properties, which we've talked about on this podcast before. The stock is up 20.8% for me. It's like my position. But if I include the dividends, it's 25.7. So 5 extra percentage points of return just from the dividend. A more interesting example, I think, because it turns the position from a money loser to a money winner is EPR Properties. Again, we
Yeah.
mentioned that one earlier in this
Yeah.
episode. My total return on that stock as of right now is just under 0%, negative 0.1% as of right now. But with the dividend, it's 7.7% in the green.
Right.
So 8% basically, almost 8% swing, just because it also pays a dividend. Now, and that's less than 4 years, because I know I haven't owned that one quite as long as my portfolio has been in existence. So, I provided that company doesn't completely fall apart, if I own it for the next 20 years, that's a pretty significant difference.
Yeah, absolutely. And I'm not going to give any other examples. I don't think it's necessary. I think we've given some really good examples already. But the other part of it too is as the dividend goes up and your yield on cost goes higher, and even when you buy like REITs, for example, because like you said, the thesis, it's the part of the reason you own them, the majority of the reason you own them is for that dividend. Right? They're built to be tax efficient. The exchange for them paying at least 90% of their real estate related earnings. There's some other, I won't get into all the details there, but of being a REIT is that they pay no federal income tax, right? We'll talk about implications for you as the investor on that a little bit later, but so the yield will be higher, right? Because that's the majority of what you're going to get. So as in exchange for that higher yield though, it lowers the bar for what you need to see in stock appreciation, which is over the long term is generated by increasing earnings per share, right? So kind of in a way, like it's a higher floor. Maybe the ceiling's not as high, because if you're paying out the majority of your earnings, how are you going to pay for growth? And generally, it's you're going to issue more stock and you're going to issue debt, right? If you're a REIT, so the dividend needs to be a bigger part of the return.
So it would be very easy if you're listening to this and you were a newer investor or newer to thinking about dividend investing, to say to yourself, I'm going to Google what are the best dividend stocks or what are the highest dividend yields right now and just buy those companies. So I did that while you were talking. I just Googled highest dividend yields and I found a NerdWallet article. And actually the first 5 stocks on it they don't give the names because I guess they want you to log in or something.
Uh-huh.
But I'm actually glad they didn't, because I don't want to mention these companies because I don't know anything about them. I don't want to give anyone any ideas about anything. But here are the yields on the top 5 that they don't give the names from 13.77%, 13.5, 13.49, 12.51, 11.53. So why shouldn't someone just do what I did and buy those 5 stocks because they say to themselves, 14% yield, that pays for my, that's higher than my mortgage. It's free money,
Right.
it makes
Right.
up for the fact that I have this high interest car loan. Like, what's the downside of just looking at yield and making investing decisions?
I'll use 3M as an example. 3M has been around for over a century, right? Every single person listening to this podcast has something in their home that was either made by 3M or there's an adhesive that holds it together that was made by 3M or some other industrial part of it that was that came out of a 3M factory. It is an exceptionally important company, and it had paid a dividend for roughly 6 decades. I don't and grown, like it paid it for more than that, but it had grown it every year for somewhere between 5 and 6 decades. So it was on, the Dividend Aristocrats, the Dividend Kings, like it was on all of those lists. And the yield for the better part of a year was super duper high. And a ton of investors were ignoring what the institutional investors were doing and what the large money was doing, which was moving away from it, and bought it, looking backwards and saying, "Oh, it's paid this dividend so long, it's grown it every year. They're never gonna not do that, right?" It's so important to their investor base. They just gutted their dividend by like 80% because the company had kind of turned itself into a mess. They had done a number of acquisitions and they had maybe underinvested in R&D, ended up with some massive litigation risk, hearing loss for military veterans because of some ear protection, forever chemicals, PFAS, right? Tens of billions of dollars in liability because of that. So the returns were getting worse, And the dividend had become such a large percentage of its cash flows that it was easy just to justify what it had done for the past 5 decades, 6 decades, and disregard how much the business had deteriorated and its ability to continue supporting that dividend had gotten worse. So, and I think its yield had gotten up to 6 or 7%, much less double-digit yield. So, if a great company with a legacy of a 3M can't maintain its dividend, we could do the same thing with Walgreens, right? And theirs was less about major missteps and a series of more of minor missteps, plus the headwinds of being in a retail business. Same thing, dividend, 5 decades plus of growth every year, gutted the dividend, gone through multiple CEOs, trying to refine the strategy. Chances are the companies that are paying the highest yield in any given sector are not paying a higher yield for a good reason. Sometimes they're misunderstood, but 95 out of 100, they're not paying it because it's high because of a bad reason.
Right. So my quick filter, if I see a really high yield, is say to myself, I want to know why it's high before I do anything. But I
Yes.
know that there is not a be all end all, but for a newer listener who's not going to do an in-depth analysis of, 3M's business struggles. And by the way, once they cut the dividend, it's too late, right? You need an
Right.
indicator earlier than that. So one thing that I've heard people talk about as it relates to dividend investing is the payout ratio or the dividend payout ratio, which is simply the percentage of a company's earnings that they
Right.
pay out in dividends. So if you
Right.
saw
Earnings per share over dividends per share.
Right. So if you saw that over 100, that means that they're paying more than their earnings in dividends, and that's a big red flag because that's not sustainable. So talk a little bit more about the payout ratio. Is there, I don't know if you ever look at that specifically or if you just would
Yeah.
rather dig in, but is there a number you like, a percentage you like, a range you like to see that in? Because one
So
that's too low might indicate that they could afford to pay a bigger dividend, right?
right.
So how do you think
Right.
about that?
So a couple of different ways. So first of all, for most companies, most corporations, the payout ratio is the most useful thing. Again, the earnings-based payout ratio. And I never use it just based on what was it last year. Companies go through different capital cycles. Maybe they take a goodwill write-down on something they bought 5 or 10 years before that undercuts their earnings, but it's a non-cash thing. And maybe it was already clear to the market that was going to happen. And anyway, the things there are non-cash financial things that can affect the payout ratio from one year to the next. So I think it's more important to look at the trends, the broader trends. Look at 3 to 5 years. Also, it's not the earnings payout ratio doesn't work for every industry. We talked about REITs, for example. REITs, one of their biggest expenses is the cost to acquire real estate. And when you acquire real estate, when you acquire any asset, then you depreciate it over time. Depreciation is an expense because you've spent the capital. The CapEx is not an expense. It's an expenditure, but it's not an expense. The depreciation of that asset over time is the expense, with the idea that you want to expense it because eventually you're going to have to replace it, right? You buy a copy machine or you build a factory or you put equipment in that factory. Eventually that equipment has to be replaced. You have to spend more capital and you create more, assets that you depreciate over
And,
time.
and to be clear, this is all just how GAAP accounting works.
It's GAAP accounting. It's just
Yeah.
basic accounting. It's to account for money going in and out
Right.
and future expenses and present expenses. Your present expenses often for depreciation of assets points towards future expenditures to replace or to improve those assets.
Yeah. A quick way I like to think about depreciation is just and I think it's the easiest example for everyone is your car,
Yeah.
right?
Yeah.
If you pay $30,000 for a car today and then you try to sell it next week, you're not going to get $30,000 for it because
Right.
it has already depreciated. So
Or 5 years or 10 years, the value goes down, it
yeah,
depreciates. So that's exactly it. Now,
yeah,
and again, for the reason it's important for most businesses is because eventually once you've depreciated that asset, in very rare instances, you depreciate something that continues to have economic value and maybe you don't have to replace it. And you've just got a little bit of maintenance expense. It's an operating expense that shows up on your book. And this is where why real estate is different. Real estate generally is an appreciating asset. It increases, it gains in value over time. So because of that, there's a better metric for REITs, real estate investment trusts, and other business. There are some publicly traded partnerships that also use FFO because the assets they own are real estate are also very, very long-lived assets as well that can appreciate in value. That's where you use FFO. So FFO takes earnings per share and then you add those real estate related depreciation expenses back into it. So it's a more accurate measure of the true earnings for those real estate based businesses. So you can do a payout ratio based on FFO for those businesses. Something else that you can do is you can use a cash based cash payout ratio, which is typically dividends divided into operating cash flow. And that tells you the cash payout ratio. So now your question is kind of what's a rule of thumb about what makes a dividend safe or sustainable or room for it to grow? The answer is it depends, which I know is incredibly satisfying for everybody to
Yeah,
hear me
no, I think we
say.
can move on. That's great.
Yeah, yeah, that's it. That's it. Thanks for listening, everybody. No, but the reason it depends is you have different industries with different capital needs, different growth trajectories, and different levels of capital efficiency. Like, for example, a utility, the payout ratio is going to be higher, maybe in the 80% range, because they do pay out most of their earnings, but they're not growing at really high rates necessarily, right? A lot of their growth is going to be just increases in rates. They're not expanding their base a ton. Maybe they're expanding it based on population growth. So they don't need to retain a ton of that cash because they're just going to screw it up anyway, because that's what management teams do with excess cash with capital intensive businesses like this. The best thing for them to do is return the majority of it back to their investors. But you might have a company like Microsoft or MasterCard that we've talked about that are incredibly capital efficient. They're not building distribution centers and buying delivery trucks and hiring hundreds of thousands of people to staff them. So they don't need to keep anywhere near as much. They don't reinvest a lot of that cash back into hard assets. So, but they have very big growth opportunities. So the smarter thing for those businesses to do is to retain more of the cash to fund their growth initiatives.
Right. So there's a lot of, the payout ratio is one thing to look at. I like what you said about maybe if you're able to access this information, go back and see what the yield's been over time, right? That could give you an indication. Like we used MasterCard as an example. It's been a great successful company growing its dividend, but the yields never got over 1%. If you all of a sudden saw it jump to 3 or 4, you should probably go see why, because there's something fundamentally has shifted with the business.
Right.
So I know that when my beginning time buying stocks coincided with the end of the 0% interest rate era, and dividend stocks were kind of compelling because you couldn't get guarantee. I know nothing's guaranteed, but you couldn't get that kind of yield anywhere else.
Right.
Like the money in my savings account was getting 0%. So a stock that had a dividend yield of 3% was attractive to me because I figured, well, I'm at least going to get 3% unless they cut it. And if there's any capital appreciation on the stock on top of that, great. Now with treasuries and high yield savings accounts up near 5%, 4 or 5%, do you think that makes investing in dividend stocks any less attractive?
No, I really don't. Because again, you have to think about the reason for owning stocks versus the reason for owning cash versus the reason for owning bonds. So, and they serve three different purposes. So with that said, I do think because of the fact that you can own a money market account and get close to 5%, you can have cash in a SoFi high yield account or Capital One account and get over 4% pretty easily. It means that you can be more choosy about what you invest in. You don't have to necessarily maybe be in as big of a rush to deploy your capital, and you can increase, like this is something that I've done and I've talked about it. Certainly the timing hasn't worked out from when I decided to do it to now, if you look at the stock market's returns, but I made the decision to increase the percentage of cash that I hold in my investing portfolios from around 5% to around 10%, just increasing the margin of safety and my optionality. So I think that's something you can do. But again, the reason you own stocks is because they can generate better total returns than an alternative asset. And if you're buying a stock just because you want to get 4 and 5% return, you're doing it wrong, right? I can't think of a scenario where buying a stock and expecting 4 to 5% in return, and like that's your threshold and you're happy with it, is really the right move, because every stock at some point is going to fall 20+%. It's inevitable that it's
Yeah.
going to happen. And earning 4% a year is just not good enough to offset, to me, the level of risk of that happening.
Right. Like you need the potential of higher than that to offset the risk of it dropping 20%.
Yeah. Yeah.
Hey, everybody, we'll be right back, but first, a word from our sponsors. Earlier in the show, you heard us talk about investing platform public.com. That's where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carries significant risk. Full disclosures and podcast description. U.S. members only. So another, I think, misconception out there is that only old, boring, stodgy companies in the last third of their life as a business pay dividends. And that's an interesting conception or misconception that's out there, especially considering some really big dynamic growth companies do pay dividends, and some big growthy, huge companies have just started paying dividends. So like, for example, both NVIDIA and Apple have been paying a very modest but growing dividend for a while now. And just recently, Meta and Google instituted their first dividends. So then I've also heard people say that dividends can actually be really great. I think it was Jason Moser, who we just had on recently. I heard him say once that dividends can be it can like help management teams get religion on being better stewards of the business's cash. So let's go there a little bit. Like, what signal does it send about the business, whether they do pay a dividend, whether they always increase it, or whether they initiate one for the first time, like we saw recently with Google and Meta?
So the first thing is it's a clear signal of financial strength when a company institutes a dividend policy and begins paying it out, because the business is saying that we have reached a point where we're generating excess cash flow that we can continue to invest in our business and our growth initiatives, acquisitions, all of the things that we've been doing. And we've got so much money coming in, we can just start sending some of it back to our shareholders. Now, I think it also does indicate a little bit of maybe a certain amount of maturity for the business when it gets to that point. But it also doesn't mean the growth is over, right? I think that's really important to remember, especially if you think about a company like Meta and Microsoft. If you think about Apple, how much has it continued to grow since it first instituted a dividend? I guess it's over a decade now at this point. It's been a while.
Yeah, it's been a while, yeah.
So that's important. It's like, to me, it's definitely a positive signal about financial strength. And again, I'm speaking broadly. It's not always the case. There are always outliers that, they're signaling something that's maybe it's counterintuitive to it. But that's the biggest thing, is it tells me that they have a dominant position, enough market dominance, strength in their cash flow, strength in their balance sheet to be able to do it. It also says that we're trying to be disciplined about capital as well, because owners of those companies have been perfectly happy for many, many years to not get dividends. I think it also says that Mark Zuckerberg wanted a bigger paycheck without having to sell any of his equity.
Yeah, that is an undercovered aspect of these big tech companies initiating dividends, which is that their founders and or executives that own big chunks of the company are now getting a lot more money.
Yeah, Zuckerberg from individually gets the better part of $1 billion a year in dividends now.
What was it, 700 million or something like that?
Yeah, so I think around 700 million a year. So, not bad work if you can get it.
Now, I would be happy with like only 600 million in yearly dividend payments. Like I would
hired.
I would just take 6.
You're hired.
All right.
Yeah.
So I do want to pivot to how we think about dividends in our individual portfolios, because I know my thinking of it has changed once and might be changing again. And I want to hear what you have to say. But I have one more question I think is worth discussing, which is, how are dividend taxed? So obviously, if you have them in a tax sheltered account like an IRA, that's a different situation. But I have some in my retirement account and I have some in my brokerage. So what do people need to know about how dividends are treated when it comes to taxes?
This is where it can get complicated.
Well, keep it simple.
Well, no, I'm going to simplify it as much as I can with the nuance that people at different situations might need to do some additional research. So by and large, you can own most stocks that pay dividends in your retirement accounts with no tax implications. Real estate investment trusts, for example, it's certainly the most tax efficient way to own them is in your retirement accounts. You can shield all of the taxes owed on all of your C corps in your brokerage in your retirement accounts. We'll talk about what happens when you sell in a second because that's where things start to get a little complex. Now, not all publicly traded partnerships and master limited partnerships, which you often see in the energy industry, are they can get really complicated to own in your retirement accounts because of something called UBTI, which stands for unrelated business taxable income, where if they actually generate a certain amount of income that then they distribute to the unit holder is a shareholder of an MLP. If you, in the aggregate, in the total, you generate, I think it's more than $1,000 of UBTI, you actually might have to pay taxes on that earnings in your retirement accounts. So if you've got a Roth and a rollover IRA, and another, like, so you've got these 3 separate retirement accounts and generates a couple $1,000s of UBTI from your midstream high yield stocks or MLPs that you own, you might actually have to pay taxes. So with MLPs, you have to be careful. It's actually one of the things I like about the Brookfield entities is it's not a zero probability, but it's very damn close to a zero probability risk of UBTI resulting in a tax bill inside your retirement account. So that's like, by and large, that's how you think about that. Now, if you own them in your brokerage account, like your Coca-Cola dividend or your big dividend aristocrat that's been paying that quarterly dividend and growing it all the time, MasterCard's dividend, those are generally what's called a qualified dividend, which means that it's going to qualify to be taxed at a very low rate of like 15%, which is the capital gains rate, long-term capital gains rate for most people, which is what qualified dividends are generally qualified for. A lot of people may not pay any income tax on their dividends if their total dividends income is below certain thresholds, even in your taxable account. So they can be very, very tax efficient. Now, REIT dividends are not qualified dividends. Again, there's no taxable income. They're untaxed as businesses, no income tax that they pay. So because they're that pass-through entity, you don't get to take the dividend and get the benefits, the tax benefits that you do with the other corporations, right?
That's why those particularly are better to be held in a tax-deferred account.
Ideally, yeah. Now, here's the other thing. I think broadly, unless you're reinvesting the dividends, if you have the optionality to own those corporations in a taxable brokerage versus your retirement account, you're probably better off doing that, particularly if you're taking distributions. And the reason why is, again, if they're qualified dividends and you own them in a taxable account, you may not have to pay income tax on a very large portion of those dividends at all. And if you do, it's probably 15%. If you're taking distributions out of your retirement account, and again, Roths are always 0%, right? So they're the absolutely most tax efficient way to own everything, with the exception of UBTI. I'm not going to get any more about that. But distributions out of your rollover IRA or your 401k are at your marginal tax rate. That's your regular income tax rate, right?
Yeah. So I think like what I would say, like when it comes to like those specialty situations, like if you're taking distributions to things like that, like obviously talk to someone who's not us,
Yeah.
just to make sure that you're understanding all that. But like, I think the general idea is like, I'm glad you mentioned REITs because that's one piece that I did know. Like they're just generally, again, speaking in generalities, better to be kept in tax
Right.
advantage account.
Well, and I guess the way I think about it is that there's the benefit, the tax with your 401k and, the rollover IRAs and that kind of stuff. There's always a trade-off, right? And you're trading off not paying any income tax on your contributions or your growth, and then you pay the taxes when you're taking the distributions.
Right.
And you may lose some of the benefits of the lower or zero taxes to grow it may result actually in higher taxes when you're at the point of taking distributions, and the efficiency may have been better off in a taxable brokerage. So, but I think it's too easy to work too hard to try to make it perfect. So don't get too caught up in it, and yeah, talk to your tax pro, and they can help you kind of be mindful about it.
All right. So let's pivot to what we each do currently in the way we think about dividend investing. I'll start. I don't think about it much. I I think it's because like I am still far enough away from retirement, and individual stocks are still such a small percentage of my overall invested wealth that I don't feel like I need to spend an incredible amount of time thinking about how many dividend paying stocks I do or don't have. That said, I have been thinking more about it because the idea of generating a substantial amount of income from dividends when I do retire in 20 years or whatever is appealing to me. But again, like so much of my, retirement income is going to come from retirement accounts that aren't in individual stocks. I don't know if I really need to spend that much time. Now, I will say this, back in, again, when I was new and trying out all different ways of investing and interest rates were near zero, you and I both had a similar, we were doing something similar based on a conversation we had with each other, which was specifically buying dividend stocks we thought could generate a total return that was higher than our mortgage interest rates
Yeah.
as a way of, as an alternative to paying down the mortgage more quickly. Because we were both lucky in when we had moved and or bought our houses and or refinanced that we have low rates, which is particularly helpful now that rates are a lot higher. And getting over that hurdle didn't seem too difficult when you look at, high quality companies that pay a good dividend. I got away from that strategy personally because I found myself not making the best, because I was buying weekly at the time, and I found myself making investments into the stocks that paid dividends in that sort of portion of my portfolio when I had a better idea in the other part of my portfolio, if that
Yeah.
makes sense.
No, it
So
does.
I got away from that. I still own a lot of those companies I bought for that purpose, and they're still paying dividends. And two of them I mentioned earlier when we were talking about the difference between stock appreciation and total return. So that's I don't, to summarize, I don't give too much thought to it right now. Although I have been thinking about maybe I do want to focus on that a little bit more in the coming years. Let's just say for the future. But I'm curious if you have like any strategy or
Mhm.
way of thinking about it for yours.
I do, and I've talked about this multiple times over the past few years, but it's actually been a long time since we really had one of these more portfolio level strategy sort of conversations. And my portfolio, I take a barbell approach. So one end of the barbell is, and it's not balanced where it's exactly 50-50, but it's just thinking about two very different ends to the barbell. At one end is focused on more growth, businesses, disruptors, trying to find companies that are going to be like a CrowdStrike, I think is a good example. We could also even include like Trex in that, where they're like a category creator, those sorts of businesses where right now the best thing that they can do with every dollar they bring in is reinvest it back in the business to grow, right? Take more market share, grow revenues, improve their operations, and then over time maybe turn into like a MasterCard or an Apple or one of those companies that down the road, like once they get to a certain level of scale and cash flow, then they start giving some of that back to shareholders. The other end is a dividend focused part of the portfolio. And this is a couple of things. Number one, just from an intellectual perspective, the long-term returns of companies that pay and grow dividend over the long term is market beating, right? So it's a great way to generate returns, also kind of offset some of the risk of, because I do operate a little bit more like kind of almost like venture capital with the growth side of my portfolio. I take on a lot more risk. I invest in companies that can be more binary, that may or may not turn into anything at all, right? And I can lose 97, 98% with some of these. But then if you have one that generates 500% returns or 10x or something like that, it more than makes up for a ton of losers and still generates strong wealth. I want a little bit higher floor with the dividend paying companies, right? So it's stability, it's ballast in my portfolio,
Right.
which I think is really useful. And I tend to take larger positions in those companies because they are stable, and I'm not looking at small bets. And then the company's demonstrating that they're earning more of my capital by doing well, and then I buy more of them, right, over time, as I do with kind of the growth stock side of my portfolio. Just kind of a number to put out there to kind of contextualize it. I own a little more than 90 stocks total, and in that mix, about 25, a little more than 25 are dividend stocks in terms of percentage of my portfolio. So that's, call it a little more than a quarter of my portfolio. But in terms of the value of my portfolio, it's about 38% of my portfolio's value. So again, I'm taking bigger bets because there's are safer businesses that can provide ballast. And if I have a lot of those kind of VC higher risk growth stocks that don't pan out and drag down the returns of my portfolio, then I'm going to get some uplift from the dividend stocks that I own.
Yeah, it's interesting. I don't know. I don't have the time right now to figure out like the percentage of my portfolio that in terms of like the total value of it that are dividend stocks, but just numbers wise, about 36% of the stocks I own are dividend payers.
Mhm.
And most of that is from that now abandoned strategy of trying to get over the hurdle rate of my mortgage.
Right.
And, but not all. I mean, I do have, like I mentioned earlier, I have some of the tech companies that pay very, very tiny dividends like Nvidia and Apple in my portfolio. All right. So just to wrap up, I have one of the things you and I have talked to each other about as it pertains to dividends is, and I forget, I think you said it to me, but I think we've both heard other people say it, which is sometimes your biggest dividend payer 20 years from now will be a company you own right now that doesn't pay a dividend.
Yeah. Yeah.
Case in point, if you had owned Apple since the 80s and then it started paying a dividend, 10 years ago, 15 years ago,
Right.
obviously you bought it when it wasn't paying a dividend. So
Yeah.
what's the stock in your portfolio currently that you absolutely expect will pay a dividend at some point?
So the first two that come to mind are Access Financial, the online bank and financial services company, and Trex, which I mentioned earlier. Again, right now, it makes the most sense for them to continue to reinvest the money back into the business and continue to expand and grow. But at some point, you know, hopefully 10 years from now, not 5 years from now, they've grown to a point where this is the best thing they can do with their capital. One recently that's done that for me is Meritage Homes. They implemented a dividend policy not too recently, actually a little sooner than I expected, but that's what you want to see. You want to see because when a great company that's done really well for you for a long time gets to that point, it means everything's worked. Like everything's worked. Like love it when a plan comes together. What about you, Jeff?
So the one that I think is probably most likely to, and I maybe wouldn't have said this before Meta and Google started to pay theirs, or Alphabet, I should say, but Amazon does not pay a dividend.
Yeah.
And that's interesting to me. I feel like they're going to be around for a while.
Chance.
Yeah, there's a chance. So like, I would say, if I'm looking at like retired me and I still own the Amazon stock, I'm going to expect that they're paying a dividend. The one I think is fascinating, and we both own it, is will Berkshire Hathaway ever pay a dividend? It seems pretty clear that for as long as Warren Buffett is in charge of the company, the answer is no.
Yeah.
But a lot of smart people who I admire are of the opinion that, at some point he will obviously no longer run the company. And a lot of people feel like that will be the time when they do pay a dividend. But who knows? Maybe the culture is so ingrained in the future leadership that they won't. But just, I mean, that.
Well, and everything we've heard about Ted and Todd, their so far their execution is they've actually been better capital allocators, better stock pickers than Warren has in their time with him. We're over a decade with both of them at this point. So not so fast, my friend.
Yeah, I guess we'll
We'll
find
s-
out.
We'll see. We'll see.
All right. I think we're near the end here, but one more thing we didn't talk about that I want to see if you have any thoughts on, and that is what about bonds?
Yeah, that is a great question, and it is an important question for dividend stock investors to consider. And it's so big that it's going to be on a future episode, Jeff.
Yeah. Well, good. Then I'm glad I forgot to ask it till the end. That can be our That could be our teaser as we wrap things up here.
Yeah, no, we'll definitely do a future show where we talk more about bonds because it definitely deserves its own category. And our investors, they deserve that, Jeff.
All right.
Okay. We did it though, right? We did it?
We did it.
Words about dividend stocks. They are things. Okay, friends, as always, just a reminder, Jeff and I love to give our opinions and give our answers about these hard investing questions. Where do dividend stocks fit in our universe? It is up to you to figure that out for yourself. You can do it. I believe in you. Okay, Jeff, we'll see you next time.
See you next time.